All right, hey, welcome back, Principles of Accounting One. I was just telling everyone here in the classroom that time goes by so quick. We already made it to week 6 of the fall 2025 semester. I don't know where the time goes, so I just don't. So I wanted to quickly call your attention to the classroom, where we are, where we're heading, just to kind of recap things. Last week we had an opportunity to talk about merchandise operations, gave you plenty of examples from my favorite store, Macy's. We had a conversation about inventory from a retail perspective, all the crazy stuff that happens in retail, like returns and allowances and how we purchase inventory. We had some really good conversations around that. So hopefully you're enjoying the course so far and all of our conversations with all this exciting stuff that we learn in business. And as I've said before, this isn't just something that we do individually as accountants, because ultimately, at the end of the day, even if you're not going to be an accountant, which I'm sure most of you are not going to go down that road, even if you go just into business as a business manager, as a business owner, whatever the case might be, you will be using this information at some point. So I just want you to just keep that in mind as we're going through. So what I'd like to do now is bring you into week 6, which is where we are today. Today being the last day of September, and today we're going to be talking about inventory and cost of goods sold, also known as cost of sales. And we'll walk you through some calculations and some really key information related to inventory. For this Sunday night, of course, you have your quiz. And the great news is, I think that's about it. I don't think that there's any LinkedIn Learning certificates like or anything like that that's due this week. So that's nice. It's just really just the quiz. So, as always, just make sure that try to get your work in on time or as close to on time as possible, right? Reason being is because there's so much information going on in this course. There's a lot to do. So it's just, I want to make sure that we're all getting in on our stuff on time. Yeah. So if you ever need any help with that, if you ever fall behind, if you have questions about anything, please reach out to me. You know that I'm here for you. You know I'm here to help you. So if you ever have any questions, just reach out to me. I'm here for you. So okay, let's go ahead and jump in on our conversation related to inventory and the cost of goods sold, also known as cost of sales. So uh, we already know what inventory is. We've had this conversation before. In fact, we started having a lot of this conversation last week related to inventory as we are talking about retail entries and all of those great things. Uh, and if did we already talk about this? I mean, this sounds so darn familiar. Do y'all remember? Did we kind of go through this last week? I just don't. It feels like deja vu. At least to me, it does. Can any of you confirm? Did we go through this last week? It just feels like we did. I just don't remember. Any of this look familiar? Like first in, first out, last in, first out, weighted average, specific identification. So we talked about that last week.
We did do first in, first out. I remember that from last week.
You do remember that?
Yes,
Okay. Did we do the other ones or no? I just don't remember.
I remember first in, first out.
You do. Okay.
Yeah.
Almost makes me feel like we've done this before. It's like deja vu, right? So, well, we'll go through it, okay, because that's what we're supposed to do this week. And if you have any questions along the way, feel free to interrupt me, or if you're like, yeah, Dr. B, I think we talked about that before. Yeah, I appreciate that feedback. So, but let's go through it, and I want to do a comparison of first in, first out, last in, first out, and weighted average. Because it's important for us to, as managers to understand why we go through these types of analysis or why we go through this type of inventory valuation methods. So that's what we're going to do today. So first, I want us to talk about. Yeah, no, we definitely did not talk about this part. Okay, I feel better. But we did talk about first in, first out briefly last week, or last in, first out, first in, first out. Uh, so I want to talk about inventory itself and the type of stuff that happens with respect to inventory. Uh, Understanding what inventory is and how we categorize the inventory is really important. Inventory, we classify inventory as what the company holds available for sale. That's it, what inventory is. It's what we hold available for sale. If we hold it ourselves and it's available for sale, we call that inventory on our balance sheet. Okay. For retailers, they call it merchandise inventory. Uh, when it comes to our inventory, it's also important for us to be able to understand when it's classified as being inventory. It could be while it's in transit. We might include it in our inventory while it's on our way to us. Okay. It depends. It depends on who's responsible for the inventory while it's in transit. If we're responsible for the inventory while it's in transit, meaning we paid for the shipping and it was free on board shipping point, and that we're ultimately responsible for it, then we should be accounting for that as being in inventory already. So that's when we account for the inventory. Another thing to consider is who owns the inventory. Uh, and that depends if ours to sell, we holding it available for sale, or if somebody else's. If somebody else's, it's not technically ours. Okay. Have you ever been to a consignment shop? Have any of you ever been to a consignment shop? Just, you know, uh, just call one out if you have. Feel free to unmute your mic and say, "Yeah, I've been to a consignment shop." Do you, do you know what a consignment shop is?
Yes,
It's
I've
like the
been.
thrift
Yes.
store, right?
Like a thrift store, kind of. Anastasia, have you been to one specifically?
I think there are a few in DC, like one on Capitol Hill, but it's like mostly for women, and one on DuPont Circle.
Sure. Yeah, excellent. Um, yeah, there's a few yeah, you had mentioned kind of like a thrift shop. Yes. So here's how a consignment shop works. I've been to a couple myself. I do enjoy shopping at these consignment shops. So the way that it works is you walk into, and it feels just like any other retail store would that sells maybe used items or clothing or whatever, something along those lines. With a consignment shop, the way that it works is someone like you or I who wants to sell our used items like used housewares or used clothing or whatever, instead of selling it on like eBay or some website or whatever, we might bring it somewhere to ask them to sell it for us. That is what a thrift shop or a consignment shop is. Okay. The way that a consignment shop works is that people like us take our used clothing, used housewares, whatever, we want to sell it. We want to sell it in a physical place. We bring it to a consignment shop. And the way that it works is the owner of the consignment shop will say, okay, that's your stuff. You own that stuff. We'll sell it on your behalf at our store. Okay. And so what they'll do is they'll put special tags on all this stuff that you're trying to sell there. You're giving your items to them on consignment, meaning they're ultimately going to sell it on your behalf. We call that on consignment. Okay, that's what a consignment shop is. It's also important for us to understand the inventory when the goods are damaged, if they're received as being damaged, or if they're obsolete. Okay. Do you know what an obsolete good means? I know some of my students in my if you took macroeconomics with me last night on campus, you know what an obsolete inventory is. What does it mean if the product is obsolete? That's my question to you. Tamika.
Does that mean not able to sell?
Well, I mean, we technically could sell it, Tamika, but you're on the right track. What happens when something is obsolete? What does that part mean?
They usually make them like little sale items, right? Cheaper.
They do. They end up putting them further on sale. Bria.
Uh, Final sale, the product is no longer maybe.
Yeah, exactly. Yeah, yeah, very good. Yeah, you're all correct in answering that. So I want you to think about it means no longer available. Kind of. I mean, it's still technically available, but it's like super old. They're not going to make any more of them, right? Um, so so I'll give you a classic example. I don't even know what iPhone number we're up to these days. So let's say iPhone, I don't know, 16, I think it is, or 17, I don't know. I don't whatever it is. So the latest iPhone recently came out, and so the model before that is obsolete. It's being replaced by the newer model. That's what obsolete inventory is. It's been replaced by a newer model. They're not going to make any more of it. And then whatever else is available for sale, they're going to discount it heavily and sell it. Try to get rid of it. If they can't, they'll recycle it or destroy it. So that's the process. So so it's just important to know what that is. So goods in transit. Let's talk about when the inventory is being shipped to us, the retailer. So we purchase our Macy's is purchasing their inventory from their distributors, and the distributor will say, "Hey, that inventory that you purchased Macy's, we are going to charge you, Macy's, the cost of shipping, and ultimately you, Macy's, are responsible for the inventory while it's in transit." In that case, they call that free on-board shipping point. What it means is that the buyer pays for the shipping and the buyer is responsible ultimately for the shipping from the point that it leaves the distributor while it's in transit to the buyer. We call that free on board shipping point. The buyer is responsible from the point of which it was shipped from. Okay. The other method of shipping is called free on board destination. This means that the seller paid for the shipping and the seller is responsible for the inventory while it is in transit to the buyer. Okay, so the way that we treat inventory in these two cases, free on board shipping point, the inventory is in the buyer's possession from the point that it was shipped from. For the free on board destination, the inventory doesn't get counted until it arrives at its final destination. So that's the primary difference in how we account for inventory between those two methods. I know that we briefly touched on those methods earlier on, but that just helps you to understand who is accounting for the inventory. If it's does it get accounted for at the point where it ships or the point it is received.
Dr. B, I have a question. This is Janet.
Janet, yeah, please.
what about for international goods? Because sometimes with international goods, at least I know when I order something, it might go to one destination and then from that destination inland, it goes to yet another designated point before it's actually received by so the shipper or the receiver, it's like so many destinations in between.
Yeah, I know exactly what you're talking about, Janet, and we call those holding points, right? So here's to Janet, to your point, and we actually did talk about this yesterday in our macroeconomics class briefly when we talked about international trade. And so to your point, to your question, is it depends on who's paying for the shipping. So when you send something internationally, let's say you're shipping something from the United States to, let's say, South Korea, for example, it's probably going to make several stops along the way, and it might get held up in customs in any of those countries as it makes its way across the world. And so, to your question, who's responsible for that inventory? It depends on who's paying for the shipping. So if you're paying for the shipping and you're sending it to your customer in another country, ultimately you're the one that's responsible for that inventory until it reaches the customer. Now, if the customer was the one that was paying for the shipping, they're technically responsible for that inventory while it's in transit, which is typically how international transactions work. So, for example, if I purchase a product from Italy and I want it shipped to me here in the United States, I typically pay for the shipping, which means I'm responsible while it's in transit. So if that product that I purchased winds up in holding somewhere, somewhere in between here and there, like in the Bahamas or whatever, I'm still responsible, right? So if customs goes through that and they say, hey, the value is this, therefore you're also responsible for paying the tariff on it, then I have to pay the tariff. So ultimately, the buyer in that case is responsible for the inventory while it's in transit. So that's a great question, and I hope that helps to kind of clarify that for you. So ultimately, who's paying is the one that's responsible. Is the short way of answering your question. So excellent question. So yeah, there's a lot behind the tariff situation as well, but ultimately, whoever pays that tariff is the one that's responsible for that inventory. So if something's wrong with that inventory or something happens to that while it's sitting in customs, then you're still responsible for it. Yeah. So that's just how that process works when it comes to international transactions. The other concept I was telling you about, the goods on consignment with a consignment shop, the person that owns the goods, that's the person bringing the items to that consignment shop. You're still the owner of that inventory. So let's say you want to sell some of your used clothing or home items through a consignment shop. You're the owner of that inventory. You are what we call the consignor. The consignee is the person who sells the goods on behalf of the owner. The consignee is the consignment shop itself. Okay. The inventory is included in inventory of the consignor. The owner of the inventory is the one that holds the inventory on their balance sheet. The consignee, the consignment shop itself, actually technically does not have any inventory because they're not the owner of the inventory. That's the way of thinking about consignment shops. The next topic I want to talk about is the goods that are damaged or obsolete. Damaged goods are damaged goods. It means that the inventory was damaged while it was in transit, or maybe there was a defect with it in the manufacturing process or whatever. Uh, Obsolete goods are goods that have been replaced by newer models. They are no longer in date. They have been deteriorated. They are obsolete. Both damaged goods and obsolete goods could be sold. There's nothing preventing um, a retail operation from selling damaged or obsolete goods. If we cannot sell them, meaning they're so damaged, there's no way I can sell this. Like a scratch and dent, hey, no big deal. But if it's like, hey, the electronics are all messed up, there's no way, no one's going to buy this. We take it out of our inventory, or they're never reported in our inventory if I can't sell it. For obsolete goods, same thing. Some retailers, they'll sell the obsolete goods at a discounted price. Some will do that, or some will say, "Hey, you know what? There's no way I can sell this." So they'll either destroy it or they will send it back to the manufacturer to be reprocessed or recycled, if you will. So if we cannot sell it, we do not include it in our inventory. If we can sell it, we include it in our inventory, but we record its cost at what we call the market cost or net realizable value. That's what we think that it would be worth. The net realizable value is also known as the replacement cost. And it's the net realizable value is the sales price minus this cost of selling it. That's what we call the net realizable value. Sale price minus the cost of selling it. Net realizable value. This is typically below the purchase price, below what we paid for it. So we record it as a loss in most cases. And if there's a loss of the inventory itself, meaning it was damaged or obsolete while it was in our possession, we record that as a loss. We just expense it out. We debit it to cost of goods sold, and then we credit the inventory, and it's typically below its cost. So that's how we treat damaged or obsolete goods. When it comes to our inventory costs, I call these landed cost. What I mean by that is when I purchase inventory, let's say it's organic food products like the stuff I used to sell in my business. Let's say I purchase some organic food products from my distributor, and the cost of the inventory is not just the purchase price. The actual cost of the inventory is what I call my landed cost. It includes the cost of shipping, storing the inventory, the insurance while it was in transit, and any import tax or tariffs that I have to pay on that inventory. All of those costs are included in the total cost of the inventory. That's why I call it landed costs. Okay? It's just a term that I use to help me to understand it. So, landed cost means it's been delivered to me. It's landed. It's landed in my possession. So the total cost of inventory includes shipping, storage, insurance, import taxes, or tariffs. So it's a cost plus those other costs, and then we subtract out any discounts that we received. Meaning, if I paid for the inventory 210 net 30 or some other credit terms, I take that discount amount out of the total cost of the inventory. Any questions? Total cost of inventory? Great. Awesome. Thank you. So, moving forward, talking about our internal control processes and taking physical counts of inventory. A long time ago, when I was working for Sears, back in the early days, right? Sears. When I was working for Sears, um, about twice a year, we would have to do physical counts of the inventory. And we would compare that to whatever our inventory system said that we had on hand. The idea here is that um, we need to make sure that none of our inventory, fell off the back of the truck or was stolen or damaged or whatever's. So about twice a year at Sears, we would do a physical count of our inventory and match that against what we have in our inventory system. We did this because we wanted to make sure that what we had in our system matched what we actually had on the store floor. And we would do this using an internal control system. Pre-numbered inventory tickets. We would put all the tags on all the inventory with the physical counts to make sure that it wasn't counted twice or something like that. This confirmed that, yeah, we had the inventory on the shelf. It was in the condition that we said it was, um, and all that good stuff. And we would also have somebody else go through again and count a second time just to make sure that the first count was correct. And then the manager would go through and confirm and validate that the physical counts were correct. That's part of our inventory control system that we had. A lot of retailers do this type of system. Very important to do so because you want to make sure that there was no shrinkage as a result of lost inventory. Uh, so once we know how much inventory we have, we need to assign a value to that inventory. The value of the inventory depends on the type of company that we are. Okay, there's four inventory valuation methods that companies use, three of them primarily. First in, first out, last in, first out, and weighted average are the most commonly used inventory methods. Specific identification, as the name implies, is specific to the individual product or individual unit. I'm going to give you examples of each of these. Specific identification. We, in retail, the only type of companies that use specific identification would be like car dealerships, for example. A car dealership would use specific identification because each vehicle has what we call a VIN number associated with it, a vehicle identification number associated with each vehicle. Each vehicle is unique and has a VIN number associated with it. In accounting, we would use the specific identification accounting cost method associated with that. We assign the cost based off of that unique vehicle. Another example of specific identification would be any product that has a serial number associated with it. An example I would give here would be like a fine jewelry company. Example of a watchmaker, Rolex, right? They have serial numbers associated with fine jewelry. So if you own a piece of fine jewelry, take a look at the band or back of the watch or whatever type of jewelry it is. You might find engraved in there a couple of numbers. That's a serial number. All right. And so that serial number is unique to that product. So that's another area or category of companies that would use specific identification. The next one I want to talk about is first in, first out. As the name implies, I'm selling the first inventory that I received first. I'm selling the first inventory that I received first. Okay. First in, first out. That's what the name implies. Examples of companies that use first in, first out would be grocery stores. Think about how a grocery store operates. Think about the type of products that a grocery store sells. Let me ask you all. You've been to the grocery store, I'm sure. Let me ask you, what about these products that grocery store sells? What makes those products unique? Why would they use first in, first out? Any thoughts? Why a grocery store uses first in, first out? Kia.
For expiration date?
Yes, correct. You're absolutely right. These products the grocery store sells, they expire. They get old, no longer can I sell them. I cannot sell expired stuff at the grocery store. Okay? So that's why grocery store uses first in, first out. Yeah, very good. The next one we'll talk about is called last in, first out. What this means is that the company's last purchases that we've made are the inventory that I'm going to sell first. Last in, first out. Examples of companies that use last in, first out is pretty much everyone else. All right. Companies that do not sell perishable goods are companies that use last in, first out. Pretty much everyone else. All right. Amazon will use last in, first out. Amazon, you got your other retailers like Macy's, they use last in, first out. Walmart, they use last in, first out. Target, they use last in, first out. Pretty much all retailers except for retailers that sell perishable goods, like grocery stores. They use last in, first out. And then we have weighted average. Weighted average, as the name implies, we take all of our purchases and we divide across to get the average cost of our inventory. Okay. Who commonly uses weighted average? It depends. I mean, the companies had the ability to select either first in, first out, last in, first out, or weighted average. They can use them throughout the year, and then they can convert to last in, first out at the end of the year before they pay their taxes. And I'm gonna explain all of these methods a little bit deeper. So this slide here, I love, love, love this slide because it does an amazing job of explaining the primary differences between the three primary methods of inventory valuation. So first we take a look at first in, first out method here on the left. And as the name implies, it means that we're selling our first inventory purchases that we've made first. First in, first out. So here we have an example. Let's say this is, I don't know, let's say this is Nike, okay, the shoe retailer, Nike. All right, so the Nikes, the retailer purchased 3 pairs of shoes from Nike. Okay, the shoe retailer purchased 3 pairs of shoes from Nike. The first pair of shoes cost $45. The second pair of shoes cost $65, and the last pair of shoes that the company bought in May was $70. All right, let's say it's all the same pair of shoes. The cost just so happened to rise for whatever reason. We sell as the retailer. We sell each pair of shoes at $100. Okay, so we sell the pair of shoes for $100. The cost of goods sold under the first in, first out method is $45. Reason being is because it was the first purchase that I made. Therefore, I'm going to sell that first. Okay? So that leaves us with a gross profit of $55 under the first in, first out method. Sales minus cost of goods sold equals gross profit. Our ending inventory balance on our balance sheet is $135. Ending inventory represents the inventory that's left over. Ending inventory. And how we got 135, we added up our remaining purchases. So 65 plus the 70 gives us 135 remaining inventory balance. or ending inventory. That's first in, first out. Now let's compare that to last in, first out. Last in, first out, as the name implies, I'm going to sell my last or most recent purchase. I'm going to sell that first. Okay. So here we have last in, first out. Our last purchase on this example was $70 on May 6th. So I'm going to sell that first. Last in, first out. We sold it for $100. The cost of goods sold is $70. Cost of goods sold represents the most recent purchase. Last in, first out. $70 cost of goods sold gives me gross profit of $30. Sales minus cost of goods sold equals gross profit, $30. My ending inventory is my remaining inventory, which would have been my older purchases. $45 plus 65 is 110. Okay, so that's last in, first out. And now let's compare those two to weighted average. Weighted average, as the name implies, is we take all of our purchases and divide that by the number of purchases to get the weighted average, as the name implies. So the way that we do that is we take our three purchases, 45, 65, and 70, add those all together to get 180, divide by three purchases, giving us an average cost of 60. Okay. So we sell one of these inventories. We sold it $100. Cost of goods sold is 60. Right? That's the average. 100 minus the 60 equals 40 gross profit. Remaining inventory or ending inventory is 120. 60 plus the 60 because I got two left. 120. Now, you'll notice the differences between the three. The differences are the cost of goods sold amounts and the ending inventory balance amounts. Now, it always works this way. First in, first out always has a lower cost of goods sold and a higher ending inventory balance. First in, first out always has a lower cost of goods sold and a higher ending inventory balance. Last in, first out always has a higher cost of goods sold and a lower ending inventory balance. And a weighted average will always fall somewhere between first in, first out and last in, first out. Now, looking at that and understanding how our gross profit works, I want you to assume a couple things. One is, under first in, first out, we have a higher gross profit. Under last in, first out, we always have a lower gross profit. The reason why companies will either use last in, first out throughout the entire year or convert to last in, first out at the end of their year is because of taxes. If I have a lower gross profit, that means that I'm going to pay less in taxes. Okay. That's why the majority of companies will use last in, first out or convert to last in, first out at the end of the year because they want to pay less in tax, which is totally acceptable under US GAAP. So that is the differences between the three primary methods. And we'll dive a little bit deep into these. We'll dive deeper into these because I need to help you to compute them. Now, sometimes we need to be able to calculate the company's merchandise that we have available for sale. Okay, well, I don't know how much inventory I have available for sale. Well, let's calculate it. We can do that in one of two ways. One way is that we take our beginning inventory balance and we add all of our purchases. Pardon me. We take our beginning inventory balance and we add all our purchases. That gives me my merchandise available for sale. Another way to do that, if we didn't have some of that information available to us, or we wanted to figure out for future sales, we could take our ending inventory and add that to cost of goods sold. That'll also give us our merchandise available for sale. So really there's two ways to calculate merchandise available for sale. One is beginning inventory plus purchases. The other way is to take ending inventory plus cost of goods sold. They both give us merchandise available for sale. So now that we know how to compute merchandise available for sale, I want to talk about how we can calculate under specific identification, first in, first out, and last in, first out, and weighted average, how we calculate our inventory. And we're going to do that under the perpetual inventory system. Briefly, last week, I know that we talked about the difference between the perpetual inventory system and the periodic inventory system. As the name implies, the perpetual inventory system means that we continuously are updating our inventory as purchases and sales are made. Perpetual or in perpetuity. Think about perpetual motion. Okay. It follows the physical flow. So the effects are, of course, our ending inventory on the balance sheet and our cost of goods sold on the income statement, just like I showed you with first in, first out, last in, first out, and a weighted average. So I want to go through the calculations of all four methods with you using the perpetual inventory system. So here we have a bunch of data. We're going to use this example from this mountain bike company that buys their inventory and sells them. So they buy the completed bicycles and then they sell those completed bicycles to their customers. It's a bike shop, okay? So here we have data for the month of August. We have inventory data for the month of August. August 1, we started the month, so this would have been ending inventory from the prior month. We started the month of August with with 10 bicycles in our inventory, and the original cost of those 10 bicycles was $91, giving us a total cost of $910. August 3rd, we purchased more bicycles from our supplier. We purchased 15 of them at $106 a piece for a total of $1,590. So that updates our total inventory to 25 bikes. On August 14th, I sold 20 bicycles, okay, at $130 a piece, which brought my total inventory down to 5 units. So on August 17th, I purchased more bicycles from my supplier. Purchased 20 of them at $115 for a total of $2,300. That brought my total inventory up to 25. Then I purchased some more, 10 more, on August 28th at $119 a piece for a total of $1,190, bringing my total inventory up to 35 units available for sale. Then I sold August 30th 23 bicycles at $150 a piece was the sale price. That gave me 12 units left at the end of the month, is what I had in my inventory after that sale. So throughout the month, I had 55 units available for sale. My cost of goods, my cost of goods available for sale was $5,990. And I had sold 43 units throughout the month. My units left is 12. So that's the information I want you to try to keep in mind as we go through these examples. The first one is real easy. This is specific identification. I had mentioned that specific identification, also known as SI, includes it's specific to each unit. Think of like a VIN number, vehicle identification number, or a serial number. It's specific to each unit. So it's really easy to figure out the cost of goods sold and ending inventory using specific identification. It just follows the exact cost. Okay, nothing fancy going on here. So in specific identification, using that same example, my cost of goods is available for sale is still 5,990. My cost of goods sold total throughout the month is $4,582, and my ending inventory is 1,408 for the 12 bikes. Okay, it uses the exact costing, so nothing fancy to do here with specific identification. It gets different with first in, first out, last in, first out, and weighted average. So under first in, first out, as you already know, our cost of goods sold are our oldest costs or our first purchases. Okay, that represents our total cost of goods sold. Our ending inventory represents the most recent purchases that we've made. Because remember, it's first in, first out. So I'm going to sell my oldest inventory first. So in understanding that, using our same example, I want you to take a look at the differences. So we have the same beginning balance and the same purchases we made on August 3. And so our inventory balance on August 3 was 2,500. I sold 20 bicycles on August 14th, as you remember. According to first in, first out, I'm going to sell the oldest inventory first. Okay? So I'm going to sell my beginning balance inventory first. 91 bike, $10, 10 bikes at $91 a piece was the cost. And then I'm going to sell 10 units out of my most recent purchase, which was at $106 a piece. Give me total cost of goods sold August 14 of $1,970. Updating my inventory balance to 530. 5 bikes at 106 was left. I then made some of my purchases just like before in the earlier example, so I add those to my inventory balances. Then on August 30th, as you remember, I sold, what was it, 20 something bicycles, 23 bikes, right? So I'm going to sell the oldest inventory first, just like I did before. I had 5 bikes left at 106. Sell those first. Then I'm going to sell whatever the other oldest purchase was. In this case, 18 bikes at $115 a piece. I add those together to get $2,600 cost of goods sold. And my ending inventory balance in this case was 1,420. 2 bikes from the 115 purchase and 10 bikes at the 119. So as you can see, under first in, first out, my cost of goods sold total was 4,570. My inventory balance, ending inventory, 1,420. Remember, under first in, first out, we're selling the first or oldest inventory that we have first. Okay, so that's the entire purpose of first in, first out. Also remember that under the first in, first out method, it's going to give us a lower cost of goods sold total and a higher ending inventory amount. Now let's, using our same example, look at last in, first out. So as we've already discussed, last in, first out is representative of the most recent purchases that we've made. Our cost of goods sold will be represented by our most recent purchases that we made. Last in, first out. And our ending inventory is going to represent our older inventory amounts. Okay? Last in, first out. So applying our this last in, first out concept to our example. August 1, we had our beginning inventory, and then August 3, we made our purchases, added that to our inventory balance. Then on August 14th, we made our first sale. Remember, we sold, I think it was like 20 bikes or something like that. So we sell the most recent purchases first. So what that means is that we're going to sell 15 bikes from our most recent purchase, which just so happened to be on August 3rd. So my cost of goods sold is the 15 bikes from the purchase made on August 3rd, 1,590. And then whatever's left that I sold, I'm going to deduct that from my older inventory. In this case, 5 bikes at $91 a piece. So that's 455, giving me a total cost of goods sold August 14th of $2,045. That gives me an ending inventory balance of 455. Our oldest inventory is what's left because it's last in, first out. Most recent purchases is what's sold first. So moving on to our next events, August 17th, August 28th, we made more purchases, as you recall. We just add those to our inventory balances. No problem. Now here we are, August 30th. We made another sale of 23 bikes. Now, according to last in, first out, that means I'm going to sell my most recent purchases first. I'm going to start by selling the 10 bikes at 119 a piece. That was my most recent purchase for 1,190. Then I'm going to sell from the next inventory in the history. In this case, I sold 13 bikes at one cost of 115 a piece for 1,495. I add those two together to get cost of goods sold for August 30th, 2,685. I add up all of my costs of goods sold throughout the month under last in, first out. My balance for cost of goods sold is 4,730. My ending inventory balance for the month was 1,260. Now, as you already know, with last in, first out, we received a higher cost of goods sold amount and a lower ending inventory balance by using that method. This method is probably the most commonly used among business. The third comparison that we make is under the weighted average method. Now, as the name implies, we're taking all of our purchases and we're dividing that by the number of purchases. So purchase total divided by number of purchases. We do that after each sale is made. After each sale is made. It's a weighted average, which means it's a rolling average. It gets updated after each sale is made. So a couple of steps here just to keep it easy for us. So August 1 and August 3 had my beginning inventory plus my purchases. Which gives me my total inventory balance. So real simple, I'm averaging everything out. I make my first sale. I sold the 20 bikes. The average cost was $100 a piece. How did we find the average cost? Well, real simple. We took our inventory balances after we made our first purchases. We add up the total cost of the inventory and we're averaging it out. Okay? So in this case, my average inventory was 25 bikes at $100 a piece because I had 91 and 106. 91 and 106, average that out, it's 100. Okay. So at 25 bikes. So my cost of goods sold is $100 a piece. And then that becomes my ending inventory, $100 a piece, 5 bikes was what was left. Now, as the month went on, I made more purchases. So I purchased another 20 bikes at 115. I add that to my inventory. It updates my average inventory because my total cost available for sale is 2,800 at this point, which means my new average cost per bike is 112. It's the difference. It's the average between $100 and $115. 112. Then I made more purchases on August 28th. 10 more bikes at 119 a piece. I add that to my inventory balance and I average it out again. 112, 119, the average is 114. Okay, so now I'm at 35 bikes, average cost per unit of 114. Then on August 30th, I made some sales. I sold 23 bikes at an average cost of 114 per unit. So at the end of the month, I ended up with $4,622 of average cost of goods sold and an average ending inventory balance of 1,368. Now, we look at these and just keeping those amounts in mind, I want you to think about what happened when we applied this process across first in, first out, last in, first out, and weighted average. And in comparing the three, as I had mentioned earlier, the first in, first out method is going to give us a lower cost of goods sold and a higher ending inventory balance. The last in, first out method is going to give us a higher cost of goods sold and a lower ending inventory balance. And weighted average smooths out the overall cost. So weighted average typically will always fall between somewhere between first in, first out and last in, first out. So if we do that side by side comparison, given the examples that we gave throughout those three methods, here we can see the comparison. So specific identification, as I mentioned before, it follows the exact cost, nothing fancy going on there. First in, first out, we have a lower cost of goods sold and a higher inventory balance. Last in, first out, I have a higher cost of goods sold and a lower inventory balance. And weighted average, as the name implies, it's weighted. And it's average, it smooths out the cost, so somewhere in between. So we can see that's what exactly happened between the four methods. Now, I had mentioned earlier that the reason why the majority of companies would use last in, first out, although it gives us a lower gross profit, the reason why it gives us lower gross profit is because we have higher cost of goods sold. And the reason why companies like that is simply because of taxes. We want to pay less in tax. How do we pay less in tax? Simple. If your costs are higher, that means you have a lower gross profit. Therefore, because we only pay taxes on our profits, we're going to pay less in tax. Yep. So, in the United States, the IRS actually requires that we report using last in, first out for tax reasons. So they're kind of doing that to themselves. I'm just saying, but that's why we see corporations pay less in tax based off of their gross profits because they have higher costs, and the IRS actually requires them to report in last in, first out. So they complain about it all the time, but I have yet to see Congress do anything about this. Other countries, that's not the case. Under IFRS or the International Financial Reporting Standards in other countries, they don't do that, right? They don't do that. That's silly. That's a U.S. thing. All right. So another concept I wanted to talk about briefly is called the lower of cost or market for inventory. Now, if something becomes obsolete or damaged or whatever the case might be, we oftentimes have to mark down our inventory. We have to adjust it downward. And there's a specific way that we do that. And the method we apply is called lower of cost or market. This is also called the lower of cost or net realizable value. Okay. It depends on whichever is lower. So we call market value the replacement cost of the inventory. As time goes on, my inventory becomes a little bit worth less because I still have it, it's getting older, the market price is going to go down for it. That's typically what happens, right? So I need to, if I keep that inventory, I haven't sold it yet, I need to adjust the value of the inventory downward to reflect the loss in value. And I can do that in one of two ways. It's either going to get recorded at the lower cost of the inventory or the market value, whichever is lower. That's why I call it lower of cost or market, or lower of cost or net realizable value. So let's apply that to this example. Here I have two vehicles that I have in inventory. I have a Roadster and a Sprinter, and I need to record their values at either the cost or its market value, whichever is lower, whichever is lower. And to do that, I need to make an adjusting entry. To reduce the value, I debit cost of goods sold and credit inventory. Okay, that reduces the value of the inventory. Increases our cost and reduces the inventory. Okay, that's the process. Very straightforward, pretty easy to do. Nothing too fancy about it. Now, when we're computing that, we do have to take into consideration what inventory method that we're using, whether it's first in, first out, weighted average, specific identification. We have to make our adjusting entries. With respect to net realizable value, the way that we look at this is the sale price minus the sale cost. The sales price minus the selling costs is how we identify the net realizable value. Real straightforward formula. Sale price minus the cost of selling it. Yep. Now we look at each individual inventory item that we have, and we apply this. So this is very, very common for companies that use specific identification, like a car dealership, for example. The inventory is adjusted downward. We apply the lower cost market or net realizable value to those items. We never adjust upward. So if the value goes up, we don't record that. Because in accounting, we use what's called a conservative method of accounting. We keep our numbers very, very conservative when we record them. So that's lower cost of market. The next thing I want to talk about very briefly are any type of errors that might occur as we're valuing our inventory. And this does happen from time to time. We try our absolute best to ensure that errors do not occur, but we know that they do on occasion. So this slide shows the effects of the inventory given these changes. So I want you to take a look at the top part of this slide and take a look at the overall impacts when errors occur. So if I understated my inventory balance, meaning, oh, I miscounted my inventory, it was actually higher than what I had counted. What the impact is, it means that we've overstated our inventory, our cost of goods sold. That's the impact. We've overstated our cost of goods sold if we understated our inventory. That also means that my net income is understated. Okay. It's like, oh, well, technically I understated my net income. We can make the adjustment and it'll have an impact on the second year. It'll understate my cost of goods sold and overstate my net income. Right? That's how we make the adjustment. If the inventory is overstated, this implies that I've understated my cost of goods sold and overstated my net income. So on the second year's adjustment, when I make my adjusting entry, I'm going to overstate my cost of goods sold and understate my net income, right? That's how we adjust it out. Now, to summarize the effect is that when there's an understated ending inventory, that means that we've understated our total assets, because as you know, inventory is a part of our assets. That also means that we've understated our equity, because ultimately, as we sell through, it gets reported on our equity, through retained earnings. If the inventory is overstated, that means we've overstated our assets and we've overstated our equity. So this kind of shows you the impact of what happens when we don't do proper inventory counts. It's it can be very risky to the business. So as you're going through and you're doing physical inventory counts, please, try to ensure accuracy. That's the moral of this story, in my opinion. A couple of ratios I wanted to make sure that you were aware of when it comes to inventory. One is called the inventory turnover ratio. Basically tells us how many times we're selling through our inventory. And the other is days sales in an inventory. It means how many days the inventory is sitting on our shelves. So inventory turnover, how quickly I'm selling through my inventory. The calculation here, we take our cost of goods sold divided by average inventory. Now remember, in accounting, anytime you hear the word average, it's the beginning balance plus the ending balance divided by 2. So cost of goods sold divided by average inventory gives us our inventory turnover ratio. The next ratio is the days sales in inventory, how many days it's sitting on the shelf. To calculate this, we take our ending inventory amount divided by the cost of goods sold. We multiply that by 365 days. Tells us how long it's sitting on the shelves. Sometimes in business, we love to compare ourselves or benchmark ourselves against our competitors. So here we have a comparison between Costco and Walmart, and we can see Costco's inventory turnover and their day sales and inventory for the current year. And this is pretty recent data. I think it's from last year. And we can see that Costco typically sells through their inventory 12.3 times in a year. and the average inventory is 28 days it sits on the shelf. We can compare that to Walmart, which is a pretty good comparison because the two companies are pretty relative in terms of size. And we see that Walmart's inventory turnover is 8 times, and day sales and inventory is 40. So, um, in my opinion, I'd say that Walmart does a decent job with turning over their inventory. But Costco, I think, does a good job with managing their inventory in terms of how long it's sitting on the shelves. So, nice comparison. Now, we talked about in those earlier examples for first in, first out, last in, first out, weighted average, and specific identification. I showed you the perpetual inventory system. Remember, perpetual means it continuously updates as time goes forward, right? That's what perpetual means. We can apply the same exact concepts using the periodic inventory system as well. And it has the same impacts on the ending inventory on our balance sheet and our cost of goods sold on our income statement, just as the perpetual inventory system did. The primary differences that we're going to find is that because we're not updating perpetually, because we're updating periodically, we do our cost of goods sold and our number of units available for sale and then inventory. We do that at the end of the month, right? Because it's not continuous. So there will be very slight differences with respect to cost of goods sold and ending inventory under the perpetual inventory system in comparison to the periodic inventory system. And that's what we see here with specific identification. We can see that same comparison with first in, first out. Remember, we're doing it periodically in comparison to perpetually. So instead of updating it after each sale and each purchase, we're only doing it once in a while, right? Periodically. So we can see that there are differences in our cost of goods sold and ending inventory in comparison to the perpetual inventory system. And here we again can see that same difference with last in, first out. On a periodic system, we just simply do it at the end of each month instead of updating it like we should after each purchase and after each sale. So if you're going to ask me, Dr. B, which is more accurate, the perpetual inventory system or the periodic, I would have to say it's definitely the perpetual inventory system. And with weighted average under the periodic system, the average cost for each inventory is assigned to cost of goods sold. So with that, it's even easier. We just take all of our cost of goods available for sale and just divide across, right? Instead of doing it after each purchase and each sale. So that just shows you the comparison between perpetual and periodic inventory systems. We apply both the retail inventory and gross profit methods with respect to estimating inventory. And we do that through a few steps. For our inventory estimation, we have 3 steps. We take our, they end up being the same, just to kind of show you. The first step, we take goods available for sale minus our sales equals ending inventory. The second step is we take cost of goods available for sale at cost divided by number of units, giving us cost to retail ratio. We can take ending inventory times the cost to retail ratio to estimate what our ending inventory would be at cost. And then to find the gross profit, to estimate gross profit, we take our net sales times 1 minus the gross profit ratio. That'll give us the estimated cost of goods sold. We take goods available for sale minus the estimated cost of goods sold to get the estimated ending inventory at cost. So you could use either of these two methods. They'll both give you a very close estimate of your ending inventory at cost. So, believe it or not, we made it. We made it through our discussion on inventory and cost of goods sold. And just to take you back to the classroom real quick, for this Sunday night, we have our quiz related to our inventory and cost of goods sold discussion. Any questions, comments, concerns, anything I could help to answer about this or anything else that you have? Anything at all?
Dr. B, I had a quick question.
Kia, please.
So when you said in the what was that, like Walmart and Target,
Yes,
they
ma'am.
use first in, first out, but they
Yep.
sell like items that expire too. So would they use both?
They can. So what? It depends, right? So I want you to think about those two businesses and what they primarily sell. So
Mm.
um, what they could and probably do is throughout the year they probably use first in, first out. At the end of the year, they'll convert that system to last in, first out. So, in other words, for the first for the 4 quarters of the year, they're going to report using first in, first out. The reason for that is because they're going to see a lower cost of goods sold and a higher gross profit and a higher ending inventory balance. Now, at the end of the year, they purposely convert it to last in, first out. And the reason why they do that is because obviously they want to pay less in taxes, right? So, to your point, when we compared those two companies, it depends. It really depends on the company's motive. So, if the company primarily sells, I'm just looking for the comparison. If the company primarily sells, let's say, food products, then yeah, they're probably typically going to use first in, first out, and then for reporting purposes, convert to last in, first out. If it's someone like a Walmart, where their primary goods that they sell are physical goods and things that are not perishable, then they'll probably use last in, first out. So just to give you an idea.
Okay. Okay, thank you.
Yeah, great question. Of course. Any other comments, questions, or concerns? All right. Well, thank you all so very much for your time today. Sincerely appreciate it. If you ever need anything, reach out to me. I'm here for you. But thank you all so much. Enjoy the rest of your evening, and I look forward to your work this week.
Thank you.
Thank you. Dr. B, you said complete the certificate next week, right?